Woo! As I slowly start regaining my energy, I had enough energy to buy some stocks this morning after recovering from some wicked food poisoning on the weekend. Still having a hard time just eating a full meal, but that's not important because we're in the midst of a crazy earnings cycle right when the Federal Reserve is about to speak. And I don't know if my stock purchases were a good idea to do in the mix of this or not, but hey, you take the deals where you can get them. I'm sure the rest of this year is going to be volatile as all hell, as we're going to be taking a look at some sectors of the market you need to be paying attention to because they're trading down. And typically, if history has anything to say about it, in an interest raising environment, these sectors tend to outperform. So we're going to be talking a little bit about that. And if that interests you, just consider hitting that like button, folks, because let's just take a look at the StockTwits watch list today. Talk about some of these earnings cycles that we're going to be seeing going on. But crypto actually rebounded from its bottoms, which unfortunately we cannot say about the risk on kind of investments that don't show EBITDA. So your smaller cap plays, guys, they sold off wickedly yesterday. They did rebound, but they are still getting hit the hardest today. So this is still a risk off environment, guys. And if we take a look at large caps today, I mean, everything's been in this kangaroo market where it's more of a day trader's dream where we're just up, down, up, down, up, down very aggressively. But take a look at this, guys, because on Monday, we had IBM post earnings, and a lot of people were fixated to this company because after Netflix being kind of the first FANG stock to post and it just got slaughtered on lowered guidance, a lot of people were anticipating a similar response out of IBM, but that is not what we got. So even in this crazy volatile market where there are hints of green that are capable of coming out of this earnings period. So that's good news. But taking a look at what's coming up at the close today, guys, Microsoft, we got Johnson & Johnson posting, Lockheed Martin, 3M, General Electric, Verizon, huge names that are largely going to dictate where the S&P goes from here. On top of that, guys, we got Tesla coming out on Wednesday in the midst of that Federal Reserve meeting, which starts today, but I don't think Jerome Powell speaks till the 26th or the 27th here. But with Tesla, Boeing, Intel, AT&T posting, Abbott Laboratories, I mean, this is going to be an fascinating week here. And then Thursday, finally, Apple, McDonald's, Visa, Hood, which will be a real interesting one because that's been a risk-off stock that's just been getting slaughtered, guys. So what I'd be paying attention to here most if you're looking to be buying into this market, which we're going to talk about the stocks I purchased, but what I'm paying most attention to here, guys, is healthcare first and foremost, because typically there are three sectors that outperform in a risk-off environment, an interest-raising environment, and one of those sectors definitely healthcare. And considering Moderna, Pfizer have just been kind of tanking here. I mean, look at how much Moderna's dropped from its all-time highs. And you look at the PEs that these guys are trading at right now, and they are setting up to be some pretty interesting buying opportunities for you kind of dividend investors. I mean, when you're getting a 3% starting yield on Pfizer, I'm even starting to pay attention to this. Obviously, the banks, considering interest rates are going to be going up for the next 1, 2, 3 years here, this is just going to bode well for the earnings cycle. Even though we got hit on the first earnings, I think this is setting up for another buying opportunity at a much higher starting dividend yield at a great PE ratio if you're into, say, the US banks, but obviously I'm more proponent toward the Canadian banks. And then finally, we're talking about the commodities sector. Now, I'm really curious to watch oil here because in the last interest raising environment, oil actually did fairly well, and it continues to do well right now, actually. I mean, you take a look at the 6-month performance, outperforming the S&P drastically, but where some of my fears come in with these companies is they have a hard time rebounding to all-time highs, and that's primarily because a lot of hedge fund managers, pension funds, and we talked about this a lot, they will not buy into these because they do not meet carbon emission targets, and unfortunately, that's a huge proponent of the pension fund investors these days. So it'll be neat to see if in an interest raising environment, oil can rebound. And also considering all the political rhetoric with Russia and the Ukraine right now, and Russia being primarily driven from an oil-based country, it'll be neat to see just what happens with this. And this kind of falls into suit with gold as well. I mean, gold's continuing to rebound to the upside here, guys. And this definitely seems like a gold and a silver market. So that's another part of the sectors I'd be paying attention to. But let's talk about what I bought. What did I trade? What did I do? Well, the first thing many of you might be surprised by is I actually sold Granite Real Estate Investment Trust because typically in an interest raising environment, usually REITs don't do as well. And considering this has outperformed most Canadian stocks, this is kind of a tough decision for me, but I wanted to pivot it to continue to concentrate my portfolio. And considering I only had 5,000 in it, I figured I'd double down on Royal Bank because Royal Bank is pulling back slightly here. So I managed to pick this up this morning on this little bit of a 4.5% pullback, get a little bit better of a dividend yield off of this. Now, How this is going to work out in this market, I'm not too sure, but I just really want to be concentrated in some of my banks, which on Friday, when I do a full portfolio overview, you kind of see how this concentrated weightings between these sectors have changed slightly. But I also went ahead and took on some more risk. I did buy some more Tesla at about 9.17, I think, this morning. And I had to pay a $10 commission. I only bought one share. So, I mean, that one share of Tesla doesn't make up a huge amount, but you take the wins when you can get them here. And I think buying Tesla anywhere in the 800s is the best, but I didn't get that opportunity yesterday. So today I figured, if it stays down here into earnings, which I think are going to smash earnings, but whether that does anything for the stock price will be debatable. But like I said, man, you got to take these opportunities when you can get them. So I said, you know what, let's add to let's double down on what I believe in. So we might as well pick up Tesla and the volatility this week. And I also, offered some security to my portfolio. I did pick up one share of the Vanguard Sp 500 index as well while it's trading down 9.5% here, guys. I'm going to continue to cost average into the S&P while it's trading down, because I think this is where you're going to get your best opportunities to be buying these broader market funds. And hopefully the sell-off continues. Honestly, I'm always a cost average investor, unlike me, Kevin, that's day trading the riskiest investments out there. I'm always going to be buying these companies and just kind of continuing to stabilize my portfolio, and always kind of pivoting money where I think it's going to have the best near-term return based off these cyclical macroeconomic circumstances. And you can always subscribe to see how that works out for me, because in the past it's done very well. But at this point, I pass the question off to you. How are you guys playing this market? I'm going to come back this evening, perhaps with a live stream, discuss some of these earnings, see where things go. But stay cool, stay awesome, and I look forward to catching you in the next one.